There's been a lot of news that's still coming out in the stock market. Tesla just reported its earnings, the US announced it's nearing some trade deals, and there's reports AWS may be slowing down its data center buildouts. There's a lot that I want to share with you in today's video. So let's dive right into it and start off with Tesla's earnings. So right away, we can see that Tesla stock is up slightly in after hours trading. So I went through the company's earnings report and I took some screenshots of all of the highlights that I found. So right away, we can see that Tesla's total automotive revenues declined by 20% year over year. However, its energy generation and storage revenue is up 67%, and its services and other revenue is up 15%. In total, the company's revenue did decline by 9% year over year, and its gross profits declined by 15%. Now, since the gross profits are declining by a faster rate than the revenue, it means that Tesla's gross margins are also declining. This is the exact same story for the company's operating income, and it's now down 66% year over year. And the company's operating margin was only 2.1% in this quarter. Tesla's operating cash flows did grow by 791% year over year though, but last year it looked like the company's cash flows were down quite a bit and not really a true reflection of their profitability. Tesla's capital expenditures also declined by 46% year over year, which led to free cash flow growing by 126%. The company's cash and cash equivalents is also sitting at $37 billion now and is up 38% year over year. So right away, this earnings report from Tesla does not look very good at all, in my opinion. Overall, automotive revenues are down 20%. The company's total revenue is down 9%. Gross profits declined 15%, and all of its profit margins seem to be declining. The only thing that's slightly good is that the free cash flow did grow year over year, but this is mostly because last year they had a very weak free cash flow quarter in the first quarter. So other than that, this quarter does look pretty dang bad for Tesla. But let's move on to the next screenshot. And here we can see total production for Tesla's automotives were down 16% year over year. Total deliveries also declined by 13%. However, storage deployed increased by 154%. So the energy segment of Tesla's business does seem like it is growing very quickly, but it's still a small portion of the overall company. And Tesla, in my opinion, is still very much so mostly an auto company. I know that the bulls are going to say that long-term Tesla is going to have 100 million Optimus robots and, the company's going to have $20 trillion in revenue, which I think is a little bit, it's just a little bit too out there for me personally. But right now, this company's fundamentals do not look very strong. And it's not good at all to see that they're losing EV sales around the world. In fact, if we move over to the next screenshot, we can see that Tesla's market share in Europe, China, and the United States and Canada is all declining, and it looks like it peaked in the fourth quarter of 2023, and since then, Tesla's market share in every market has been dropping, and it looks like its strongest market, it still only has about 3.5% of the overall market share. This right here does not look like a business that has a moat, in my opinion. A business that has a moat has strong profit margins that are also stable, and it does not lose market share. Tesla's business is clearly losing market share around the world, and its profit margins and even its revenues are now declining. So I personally think that Tesla's moat is successfully being attacked by other electric vehicle manufacturers. I also recently talked about this in a previous video, how over in Australia, Tesla is losing a lot of market share to BYD. So it seems like the Chinese electric vehicle automakers are successfully attacking Tesla's EV business. The shining light for Tesla is that its energy and services gross profits are at an all-time high and clearly uptrending. If we take a look at the energy storage deployments, they're also hitting an all-time high and clearly going up very rapidly right now. So Tesla's energy business is scaling quickly. Let's now head back over to Stock Unlock and take a look at some of Tesla's KPIs here. So this one is the company's total production. So here we can see that in the most recent quarter, they had 362,000 cars produced. And this was the weakest quarter since about the third quarter of 2022. So Tesla's total production has been flatlining and now declining for about 3 years now. This is the exact same story for Tesla's overall deliveries. If we take a look at Tesla's automotive sales revenue, we can see that it came in at about $12.93 billion in the quarter, which was the weakest quarter since the third quarter of 2021. So this was the worst quarter for automotive revenue in about 4 years. And we can clearly see that Tesla's automotive sales are downtrending. Tesla's automotive sales gross profits also hit a 5-year low. They're the lowest they've been since about 2019. And once again, we can clearly see that this trend is going down. However, Tesla's energy generation and storage segment revenue did produce about $2.7 billion in the most recent quarter, and it looks like it has been growing quite significantly over about the past year. If we change this to a trailing 12 months view, we can clearly see that this business is growing and actually quite substantially. But I do not think that this revenue growth rate here offsets just how much that Tesla's automotive business is struggling right now. Tesla also produced about $16.8 billion in trailing 12 months operating cash flows, which means that the business is now trading for about 45 times operating cash flows. I think that this is an absolutely insane price to pay for a business that's currently seeing its revenues decline, its gross profits, gross margins decline, its operating income decline, and all of its profit margins are going down at the same time as the revenue is also declining. Tesla is also losing electric vehicle market share around the world, so I don't think that a business like this deserves to trade for 45 times operating cash flows. And what that tells me is that the stock is still pricing in a lot, and I mean a lot of future growth. This is a higher price multiple than Nvidia today. And Nvidia's business is clearly growing significantly faster, and it is a much, much more profitable business. So when I take a look at Tesla stock versus the other stocks that are available in the market, I don't see any reason why I personally would want to invest in this one. I know that Elon Musk likes to put out some wild claims that robotaxis and Optimus are going to be worth tens of trillions of dollars in the future, but you have to understand that at a 45 times operating cash flow multiple, you're already paying for so much future growth. Like, I understand if people want to think that Tesla is not an automotive company today, but you're already pricing this stock like it's not an automotive business, and you're already paying for a lot of the other non-automotive businesses to succeed. So I think that Tesla is still very overvalued. I am not going to be buying this one at all. And I also think that this stock carries a significant amount of risk because the share price is already pricing in a lot of future business success to the other business segments that it's trying to start up. So I think investors are already paying for future success of those new business lines today. And if those business lines do not work out, or they don't grow as quickly, or they're not as profitable, then this stock will come down. So yeah, I think that Tesla is overvalued, extremely risky, losing market share, does not have a moat, and was a pretty bad report. And I'm actually pretty surprised that the stock is not down after this report. So now let's move on to some other news and talk about why the S&P was green on the day. So this article right here that came out today says the White House announced that it is close to a tariff agreement with India and Japan. However, Japan said that it is not rushing into a trade deal with the United States, and it does not intend to make compromise after compromise to get a deal done. So these things will probably take some more time, but it does seem like some progress is officially happening. Further on in this article, it also says, the White House is under pressure to show meaningful progress on trade deals, as markets remain anxious amid continued uncertainty about tariffs. The Dow Jones Industrial Average dipped nearly 1,000 points on Monday and appears to be headed for its worst April since 1932. There's a range of economic indicators putting pressure on the markets, and business leaders and investors are looking for signs of progress. Business leaders such as Jamie Dimon have also been sharing their concerns over U.S. trade policies and have been urging the Trump administration to get some deals done. Capital is currently locking up due to how much uncertainty there is in the global economy. And think about it, CEOs cannot make wise investment decisions right now if the future costs of their businesses are not certain. This is leading to an overall slowdown in capex and spending, and if it remains, then business leaders are worried that this could lead to a self-induced recession. Just yesterday, Wells Fargo put out a report saying that AWS is now pausing data center spending. It apparently heard that AWS has paused a portion of its leasing discussions, and this sent Amazon stock down quite a bit on the day. However, the vice president of global data centers at Amazon put out this LinkedIn post in response to that article. There continues to be a significant interest and speculation about the data center expansion plans of AWS and other cloud providers, so I thought I'd share some of our thinking here. First and foremost, we continue to see strong demand for both generative AI and foundational workloads on AWS. We have almost 2 decades of experience delivering data center capacity to meet customer demands when and where they need it. That experience has taught us to consider multiple solutions in parallel. Some options might end up costing too much, while others might not deliver when we need the capacity. Other times, we find that we need more capacity in one location and less in another. This is routine capacity management, and there haven't been any recent fundamental changes to our expansion plans. Fortunately for our customers, they're able to focus on their business and leave these details to us. So here the Vice President of Global Data Centers at Amazon is saying that the expansion of AWS and that the recent news is nothing more than routine management of Amazon's data centers. Amazon is also reporting its earnings soon, so we're going to have to see what they say on the call and how the business is shaping up with the tariffs and all of this recent speculation. Amazon's CEO also recently put out Amazon's 2024 letter to shareholders, and there's a lot of really great insights in this letter. So I read through the letter and took some screenshots of the most important points. And this first screenshot says, "Why is AI so important? Will it really have as much of an impact as some people claim, and when?" Generative AI is going to reinvent virtually every customer experience we know, and enable altogether new ones about which we've only fantasized. The early AI workloads being developed focus on productivity and cost avoidance. For example, customer service, business process orchestration, workflow, translation, etc. This is saving companies a lot of money. Increasingly, you'll see AI change the norms in coding, search, shopping, personal assistance, primary care, cancer and drug research, biology, robotics, space, financial services, neighborhood networks, everything. Some of these areas are already seeing rapid progress. Others are still in their infancy. But if your customer experiences aren't planning to leverage these intelligent models, their ability to query giant corpuses of data and quickly find your needle in the haystack, their ability to keep getting smarter with more feedback and data, and their future agentic capabilities, you will not be competitive. How soon? It won't happen in a year or two, but it won't take 10 either. It's moving faster than almost anything technology has ever seen. Okay, I buy that AI is a big deal, but why invest this much this quickly? Fundamentally, if your mission is to make customers' lives better and easier every day, and you believe every customer experience will be reinvented with AI, you're going to invest deeply and broadly in AI. There is also substantial capital investment required. In AWS, the faster demand grows, the more data centers, chips, and hardware we need to procure, and AI chips are much more expensive than CPU chips. We spend this capital up front, even though these assets are useful for many years. In the case of data centers, for at least 15 to 20 years. We only start monetizing this capital investment many months after we spend the capital, and over many years, which leads to attractive long-term free cash flow and return on invested capital, as people have seen with AWS over the last several years. But in periods, like now, of unusually high demand, our AI revenue is growing at triple-digit year-over-year percentages and represents a multi-billion-dollar annual revenue run rate. You're deploying a lot of capital. We continue to believe AI is a once-in-a-lifetime reinvention of everything we know, and demand is unlike anything we've seen before. And our customers, shareholders, and business will be well served by our investing aggressively now. So there's a few key points that we have already read that I want to quickly discuss. The first one is that Amazon's AI business is a multi-billion-dollar business that's growing triple digits on a year-over-year basis right now. This means that it's at least producing $2 billion in annual revenue, and it's growing by over 100% annually. That is the worst that Andy Jassy says it could possibly be. So this business is already producing billions of dollars in revenue, and it's growing incredibly quickly. Then Andy Jassy also says that he believes this is a once-in-a-lifetime opportunity, and he believes that artificial intelligence is going to change absolutely everything. And Amazon wants to be one of the companies that is a leader in AI and is providing AI for everyone. Then the last thing that I want to talk about is how AWS CapEx works, because Andy Jassy has been repeating this for a very long time. But one of the main bear cases against Amazon and all of the other cloud computing companies is simply how much money they're spending on CapEx. People are speculating that this CapEx, literally hundreds of billions of dollars in CapEx, is not going to produce a high return on invested capital over the long term. Andy Jassy is very clearly saying here that he believes this is not the case. And Amazon believes that all of this CapEx is actually going to produce long-term returns for their shareholders, because Amazon has to spend this tens of billions of dollars setting up all of these data centers. And then once the capital is spent, then they can actually see the revenue and cash flows generated from them. So this is very much so a large capital investment right now that he believes is going to bear fruit for decades to come. This next screenshot is also very interesting. So this says, related, why can't we help the hundreds of millions of people without broadband connectivity? There are about 400 to 500 million households around the world, most in small, rural towns, that don't have access to broadband connectivity. They can't leverage the internet to learn, shop, do business, access entertainment, and communicate the same way people take for granted in bigger cities. This digital divide is what Project Cooper, our low Earth orbit satellite network, aims to solve. We're just launching our first production satellites, and will ultimately have over 3,200 in orbit over the next few years. While capital intensive to launch, we believe Cooper will be a meaningful operating income and ROIC business for us. What this means is that Amazon wants to directly compete with Starlink. And I think that this is absolutely amazing because long term, I do think that there is going to be multiple satellite networks in space, giving us real-time high-speed internet anywhere across the globe. That is where the future is going. And Amazon is also pursuing being in that business. So right now, they're spending all of this capital to get satellites into orbit, and they're not receiving any revenue or cash flows from this. So Amazon, this is what Amazon's business is. They're always spending a lot of money on CapEx to get into new business segments and really just build the future of the global economy. And while they're spending all of this CapEx, their free cash flow is going to be lower. But I do think that Amazon is making a lot of smart investments. And I think that this one business unit right here could be worth tens of billions of dollars long-term in the future. And I'm very happy to see that Amazon is competing with Starlink. Now, why I am also continuing to buy Amazon today is because its price to operating cash flow multiple, which I think is the best reflection of the business's value, is sitting at about 15.77 today. Amazon's long-term average is about 27, and we're zoomed all the way out to 2006 right now. Additionally, the last time that Amazon was trading for a price to operating cash flow of around 15.7 was all the way back in 2009 during the financial crisis. So this is quite literally the cheapest that Amazon stock has been over the past about 15 years and since the financial crisis. So for some reason, the market is pricing Amazon stock incredibly low right now, and I am taking advantage of this. I am someone who is very bullish on the long-term potential of Amazon's business, and I think that this business is going to grow and be around for probably the rest of my life. So while it's trading for decade-low price multiples, and I think that they're going to continue to grow over the long term, I am continuing to add to my position whenever I can. So Amazon is definitely a stock that I am actively buying in the market, and this will be a stock that I cover on my channel when its earnings come out over the next couple of weeks. So if you want to be notified when my Amazon earnings video comes out, then make sure to subscribe to my channel and turn on notifications. But with all that being said, that is going to wrap up the video for today, everyone. And if you did enjoy the video, then please remember to leave a like on it and let me know what you think down in the comments section below. Also, again, if you're new here and you want to continue seeing more stock market related news and content like this, then please consider subscribing to my channel as well. But for now, that's going to be all from me. And thank you all so much for tuning in. I truly do appreciate it. And I hope to see you all again in my next video.